Thanks for joining this month's investment video. I'm Ross Bramwell, a member of Hammack investment team. Over the last few months, we have talked about the Fed's upcoming decision on when to make the first rate cut and how that has impacted the stock market. In this video, we will continue that discussion and talk about some of the assumptions that investors are currently pricing in as the stock market sits near record levels. Just 7 weeks ago, as we began the year, the market was pricing in that the Fed would be very aggressive since it's pivoted in early November. It was expecting that the Fed would begin to cut rates in March, as we'll see here on the brown line, and that through the course of 2024, that it would cut up to 6 to 7 times before we get to year end. The Fed, on the other hand, continued to state that it would move cautiously, and that was unlikely that it would cut rates as soon as the market expected. And we see that in the difference between the brown line and the yellow line here. Given recent solid economic data and hotter than expected inflation reports in recent weeks, the market has had to adjust those expectations. The market has now pushed out expectations for their first rate cut, not until June, we see with the higher yellow line, but then also only expecting that there will maybe be 3 to 4 cuts before year end. So in the end, the Fed currently is winning in its messaging as the market has moved closer towards the Fed's expectations. Given the abrupt change in expectations, it is a little surprising that the stock market has held up so well and even moved to new highs this month. Bond yields have moved higher as a reaction to the expectations that rates will stay higher for longer, but many believe the adjustment in expectations for rate cuts would also mean trouble for stocks. What has supported the stock market? It's actually been better than expected earnings for the fourth quarter, which were expected to be down as much as negative 1%, but they've actually come in closer to 4%. We have seen some softening in earnings expectations in both the first quarter and second quarter looking forward, but overall estimates are still for around 10% earnings growth for 2024. So it will be key that we see follow through on the earnings front. And we see earnings hit these estimates or even move higher for the current market to be supported at these levels. The risk in earnings, as many headlines have covered, is that the earnings story has really been in fewer names than most people are comfortable with. These 3 charts show their earnings story for the Magnificent Seven, as they're called, which includes Apple, Alphabet, Meta, Microsoft, Nvidia, Amazon, and Tesla, along with the broader S&P 500. So here we have the Magnificent Seven, the broader S&P 500, and then the remaining 493 stocks outside the Magnificent Seven. Here we look at the fourth quarter of net income change. We're also looking at 2003 net income growth, and then also looking at 2024, the estimates for the full year. Across the broad, the majority of these stocks, the profit is coming from the Magnificent Seven stocks. As you can see, each chart has the higher amount where the contribution is coming from. We would like to see the earnings story broaden out across the stock market this year to have comfort that this rally can really be sustained. I will also add a little bit of context here in that if we look at the largest companies in the stock market for each of the last decades, so going back to the 1970s, 80s, 90s, if you go back a few decades, you probably would have found more energy companies or maybe some telecoms, right? So some of the old companies that only did one thing, right? And then you added kind of some of the tech companies in the mid 1990s, right? Microsoft, joined that list. But then of course, over the last 20 to 25 years, technology has taken a bigger share of the top 10 and of the overall market. If you go back a few decades, some of those names that I said or industries I mentioned, these were companies that were known for one thing. They did energy and energy only, and that's what they did. Even as the tech companies, back then, right, they were either hardware or software companies. Now, for example, let's take one of the Magnificent Seven, Amazon. It's a massive retailer. It has a large real estate footprint and distribution and logistics business. It's got an advertising business. It's got a movie production company, music platform, and even a cloud business is involved in AI, artificial intelligence. And that business is really growing. It's really an aggregation of what could be several, public companies. And we could talk about some of the other dominant companies in the S&P 500 in a similar way, looking at Apple, Microsoft, or Google, among others. So although the Magnificent Seven is around 1/3 of the S&P 500 looking at market cap, as these companies have scaled, they are also a larger part of the economy. This aspect is unlikely to change in the short term, or maybe even in the medium term. These companies will continue to have an outsized influence on the stock market returns and also volatility, for better or for worse. These companies are where the growth is now and likely to be in the future, even as I mentioned AI or artificial intelligence. This is important because over the last year, the stock market is up over 20%, as shown here by the tan line. But we'll also see that valuations, how the stock market is being priced, is also up over 20%. Much of the move to the stock market highs has been driven by higher valuations, whereas earnings have only increased by about 1%. We would be much more comfortable if earnings were driving the recent run to new highs, rather than the market pricing in a lot of good news, including no more rate hikes, no recession, rate cuts, that is, by this summer, and double-digit earnings growth. That is a lot of good news that needs to occur in the current market price. One aspect, though, that gives us a little comfort about the overall market is that the higher valuation for the broader market is also based on elevated valuations of the largest stocks, as the average stock valuation across the other 493 stocks is closer to historical averages. This gives us some comfort as we maintain our current weighting of the stocks, but our outlook for stocks would shift more favorably when either one of two things would occur. First, valuations decline to more reasonable levels. Or second, the leading economic indicators index ends its almost 2-year decline and turns positive. This would indicate a declining risk of recession as the Fed evaluates when to make its first rate cut. Thanks again for watching this video. If you have any further questions, please reach out to a member of your client service team.